Let's decode the chaotic stock market into simple 2D animated building blocks. Ready to dive in?
Green and red numbers flashing everywhere. What exactly is all this chaos? Well, let's break it down.
Imagine owning a booming pizza shop. You want to open 10 more locations, but you need serious cash. So instead of borrowing, you split your company into thousands of tiny pieces, which we call shares.
People buy these pieces, becoming shareholders. If your pizza empire grows, their little slice becomes way more valuable.
This exact process, a private company selling shares to the public for the first time, is called an IPO.
Now, where do these shares get traded? Welcome to the stock market, a giant ownership marketplace.
In the US, venues like the New York Stock Exchange and NASDAQ handle millions of trades daily.
Prices aren't set by some authority. They're driven entirely by supply and demand. It's a simple balancing act. Good news sparks buying excitement, while bad news triggers panic selling. The market literally processes human emotion. Ever heard of a bull market? That's when prices are surging and investors are feeling super optimistic.
A bear market is the exact opposite. Prices plunge at least 20%, mostly driven by total fear.
But here's the kicker. Historically, bear markets are temporary. They've always bounced back into a bull market.
We track all this using market indices like the S&P 500, Dow Jones, and the tech-heavy NASDAQ.
So how do you actually make money? First up, capital gains. Just buy low and sell high.
Second is dividends. Stable companies actually pay you a slice of their profits just for holding their shares. Reinvesting those dividends creates a massive snowball effect. We're talking incredible compound growth over 10, 20, 30 years. But hold on, sinking all your cash into one single stock is incredibly dangerous if they tank. That's exactly why diversification exists. You gotta spread your money across different companies and industries to minimize risk. Index funds actually do this automatically. They let you buy tiny pieces of hundreds of companies instantly. Your biggest enemy here? Your own brain. Fear triggers panic selling, while greed makes you chase overpriced stocks. Think of the tortoise and hare. Research proves the boring, consistent investor usually crushes the panicked, active trader. As the famous saying goes, time in the market will absolutely always beat timing the market. Ultimately, the market is just a bridge. It connects people with capital to companies needing money to grow. It's a powerful system. So, will you let fear control you or use time to build long-term wealth?